I'm going to speak about Axis Dynamic Bond Fund. Another interesting way to position this product is the deferred annuity. We are aware of systematic withdrawal, which is available in the mutual fund space. The same concept, we are just tweaking it a little bit by saying it's a deferred annuity. And what does that mean? So instead of withdrawing money from day one of investments of into this particular scheme, what we can do is defer our SWP maybe after 3 years, and then you start your SWP at 7%, 8%, 9%, etc. So as you can see, lower the withdrawals at 7%, the residual value of that particular scheme at the end of the 10th year is almost 12.28 lakhs on an investment of 10 lakhs in the initial stage. Naturally, if you withdraw higher and higher amounts, instead of 7%, if you had withdrawn 9% after the third year is over, your residual proceeds are only 10 lakh rupees. But it is still a very efficient way of utilizing this for cash flow requirements by converting this into a deferred annuity. Now let's convert that instead of withdrawing the money after third year, if we withdraw money after the 5th year, what will happen? By deferring it for 2 more years, instead of withdrawing after the third year is over, if you start withdrawing from the 6th year onwards, that means you have deferred your annuity by 5 years. Naturally, you have a better cushion which has been built into this portfolio, and then thereafter you can start withdrawing at higher and higher amounts also. So if you had withdrawn at 8% instead of 7% in the third year category, your residual value of that scheme is 13 lakh rupees. And you can withdraw as high as 11.75%, and in spite of that withdrawal, your residual value is still about 10 lakh rupees, which was your original investment. So if you utilize this as a deferred annuity product for cash flow management of your investors, it becomes a very powerful tool in the hands of the investors. And this is a great advice which you can show as a value add from your side in terms of how this particular scheme can be utilized by your investors. The last positioning which I would like to speak about is how do we utilize this as a passive allocation to the debt side under asset allocation. All of us are aware that asset allocation delivers 92% of the returns of the investor's portfolio. When one asset class is expensive, which is say equity as an asset class, why would you take any risk on the debt space, which is supposed to be a temporary parking space? So utilize this scheme as a passive investment and an allocation to the debt portfolio under the asset allocation strategy, and the rest can be utilized to invest in equity market space. And as and when the equity markets go up or down, you reduce your exposure and get that money into this particular scheme. Over the next 10-year period, if you are just a passive investor, because you have already taken care of your debt allocation, you will not be bothered as far as that volatility in debt market is concerned, because you do not want to get into a situation when one asset class, which is equity, which is riskier and volatile asset class, you get into a credit risk space and create havoc in your investors' portfolio through debt space as well. So utilize this as a passive allocation towards the debt under your asset allocation strategy, and the rest can be managed through the equity space. So as I've explained to you now, this is a great product which has come at the right time. 2020 is going to be no different from 2018-19 as far as the debt market space and the credit risk space is concerned. There are many NPAs likely to come out of the closets even going forward. Our job, as I have mentioned to you, is to give investors a smooth and a less volatile journey, especially in the debt space, because they are coming from fixed deposits. Please understand the mindset of the investors who are coming from fixed deposits where there is absolutely no volatility, a guaranteed return, a regular cash flow, etc. From there, if you jump them into the credit risk space, naturally there will be volatility which they may or may not understand. They may panic and take irrational decisions, move away the investors from that space and start utilizing schemes like Axis Dynamic Bond Fund, which is a constantly rolling down on maturity, Use it as a need and a solution approach. I'm sure you will come out on top as far as your value add is concerned, your advisor is concerned, and your investors will be a happy lot. Happy investing in this scheme. Thank you so much. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.